To keep yourself updated, subscribe to IndigoLearn and click the bell icon and download our app OneFin to start learning on the go.
So we have understood how do we account for equity settled transactions when the transactions are done with the employees of the entity. Important things for us to remember is we should know the grant date, we should know the fair value on the grant date, we should make an estimate of how many employees would be entitled to the equity instruments, and accordingly we will have to calculate the expense. Every year when you charge the expense, you will debit the employee benefit expense and you will credit the share based payment reserve, right? So that is how you will do, and at the time of issue of equity instruments, you will debit the share based payment reserve and you will credit the equity share capital and if required securities premium as well. Now that is about equity settled transactions with employees. Now, what would be the case when we have equity settled transactions with non-employees? Now, say for example, there is an entity and there is a supplier. The entity wants to purchase 1000 units of a particular product, okay, and the agreement has been entered on 1st of April of year 1. The supplier has supplied these 1000 units of product on 30th of April of year 1, and against this, the entity has issued 1000 shares to the supplier. Now, tell me, on which date will we do the accounting? Because here is a transaction. Now here, because the goods have been received on 30th of April, on 30th of April we will recognize the transaction, we will record the transaction. What will be the transaction? You will debit inventory because you have acquired inventory, and you will credit the equity because you are issuing shares. Now the next question is, at what value should we account this particular transaction? Say for example, the fair value of shares on 1st of April is 11 rupees and the fair value of inventory per unit is 10 rupees on 1st of April. That is, on the date on which agreement has been entered into, fair value of share is 11 rupees and the price per unit of inventory is 10 rupees. On 30th of April, say for example, the fair value of the shares is 12 rupees and the value of inventory or the price per unit of inventory is say 12 rupees. Now tell me one thing, what will be the value that you will consider to record the transaction? Now we have understood that whenever there is a transaction with a non-employee, the first preference will be the fair value of goods and services received on the date on which we receive the goods and services. Grant date is not relevant. Grant date is relevant only when there is a transaction with employee. For non-employees, we will consider the date on which we have received the goods. What is the date on which we have received the goods? 30th of April. On 30th of April, what is the value of goods that we have received? 12 rupees per unit, so a total of 12,000, right? So accordingly, you will record inventory at 12,000 and you will credit equity by 12,000. Now this 12,000 maybe, now assume face value of share to be rupees 10, so you will have 10,000 credited to share capital, 2,000 credited to securities premium. So what is relevant when there is a transaction with non-employees? The thing that is relevant is the fair value of goods and services that has been received by the entity on the date of receiving those goods or services. Grant date fair value is not relevant and fair value of equity instrument is also not relevant. So this is how you will account for equity settled transaction. Now say for a moment we are unable to determine the fair value of inventory. Then you can consider the fair value of equity instrument and record the transaction, right? So this is the basic discussion about equity settled transactions. What is happening here? Entity receives goods and services and the entity issues equity instrument. That is what is a equity settled transaction. But please note friends, services have to be received by the entity, right? Now having understood this, let us move on to the next aspect, that is cash settled transactions. Let's now understand the recognition principles related to cash settled transaction. Now what are these cash settled transactions? Cash settled transactions are transactions where the entity agrees to transfer cash or other assets and the amount of cash or other assets that will be transferred is dependent on the value or the price of equity instrument. Now to give you a very simple example, say we have an entity and we have, let us say, an employee. The entity tells the employee that we will pay you cash equivalent of the share price of the company after 2 years. So what are we saying? Say today the value is 1000 rupees, the share price is 1000 rupees. Whatever is the value per share at the end of 2 years, that amount will be given to you and will pay an amount for 10 shares. So what are you telling the employee? You will get cash price equivalent of the value of 10 shares of the company after 2 years. Say for example, after 2 years, the value per share is 1500. How much will you pay to the employee? 1500 multiplied by 10, you will pay him 15,000. But you are paying cash. You are not issuing equity instrument. Now, here if you see, when we are paying cash or when we are transferring other assets to the employee, what are we incurring? We are incurring a liability, or we need to create a liability. And friends, the value of this liability will keep on changing depending on the value of the share. In case of equity settled transactions, you have decided that you will issue so many number of shares. Is that number of shares changing? Those number of shares do not change other than the change in estimates. You know that for every employee, say you will issue 10 shares. Is the number of share per employee changing? It does not change. So you consider the value at the grant date or the fair value at the grant date, and considering that you recognize the expense. But when it comes to payment like something like a cash settled transaction, what happens is your liability keeps on changing depending on the changes in share prices. Say for example, at the end of year 1, the value is 1100. So your liability estimated would be 1100 multiplied by 10, 11,000. At the end of year 2, it became 1500. So 1500 multiplied by 10, it became 15,000. So like this, whenever there is a cash settled transaction, the value of liability keeps on changing. And what the standard requires is, because the value of liability keeps on changing, you have to measure the fair value of the liability at the end of each reporting period. So it is not that you will consider the initial value and provide for liability. You will consider the fair value at the end of each reporting period, and you will remeasure the liability considering the latest available price information. This is one example of a cash settled transaction. Now, this is one example of a cash settled transaction. Another example could be the employer tells the employees that consider 10 shares. Today, the share price is at 1000 rupees, and whatever is the share price after 2 years will compute the difference, and I will pay you the differential amount for 10 shares. So, for example, today the share price is 1000 and after 2 years the share price becomes 1500. So, the increase in share price is what? 500 rupees. For 10 shares, the amount comes to 500 multiplied by 10, 5000. So, this can be another cash settled transaction. Now, in this case, the employee does not take any shares. The employee need not buy any shares. Just based on the growth of the share price of the company, the employee gets some kind of benefit. Okay. So, the price increases from 1000 to 1500. The employee gets 500 rupees per share. These are called as share appreciation rights. What is this? What are these called? Share appreciation rights or stock appreciation rights, where the employee has a right on the appreciation of share price. So, from 1000 it went to 1500, 500 is the appreciation. The employee is entitled to 500 rupees per share. For 10 shares it comes to 5000, right? So, even here there is a cash settled transaction, and for this the entity will recognize an expense and create a liability. In equity settled transaction, entity recognizes an expense or an asset and correspondingly recognizes amount in equity. For cash settled transaction, expenses or asset account debit to the liability account. Now, here we have discussed about two things. One is a share appreciation right, and another one is a direct settlement based on the share price. Now, whenever we have share appreciation rights, what we need to do is we need to determine the fair value of these share appreciation rights. See, the appreciation will happen over, let's say, 2 years or 3 years based on the vesting period, and the payment will happen after 3 years. Today, you have to determine what is the fair value of those particular share appreciation rights. So, for that, you can use, option pricing model that you will learn in derivatives in financial management. Based on that, you can determine what is the fair value of share appreciation rights. Now, for us in the examination, they would give us what is the fair value of the share appreciation rights, initially and at the end of each reporting period. That is one aspect. The other aspect is, it is not an appreciation right, but it is a direct payment. So, when there is a direct payment based on the value of the share, then you have to consider fair value of share at the end of at initial recognition and at the end of each reporting period to recognize the expense. In share appreciation rights, we have to determine the fair value of the rights, not fair value of the shares, fair value of the rights. What is the value that you attribute to the share appreciation rights, right? So, based on that, you'll have to do the accounting, and if it is a direct share based And if it is a direct payment based on the share price, you will have to determine the fair value of the shares, right? So these two things you have to keep in mind. Initially, based on the fair value, you will recognize the liability, and subsequently at the end of each reporting period, considering the revised fair value, you will determine what should be the expense and what will be the liability. Now consider one example. Say we have an employer and we have an employee. The employer is happy with the employee that the employee has worked hard for 5 years, and the employer tells the employee that because you have worked in the company for 5 years, we are happy with you and we are giving you 100 share appreciation rights. We will consider the value today, say for example 1000, and whatever is the value after 2 years, the difference between today's value and value after 2 years will be paid to you, and we are giving 100 share appreciation rights. Now here, is there any vesting condition yet to be fulfilled by the employee? See, the employee has already worked for 5 years, and considering that the share appreciation rights have been granted, the employee is not expected to work anymore. Even if the employee leaves, the employee is entitled to receive this payment under share appreciation rights. Now in such a case, because the share appreciation rights have already been vested, you will immediately recognize the expense considering the fair value of the share appreciation rights, and subsequently also if the fair value changes, you will recognize the expense immediately at the end of each reporting period. Okay, here you will not say that we will recognize the expense over a period of 2 years. Why? Because the share appreciation rights have already been vested, there are no future service condition. But if there are future service condition, let us say we tell the employee that you will get the payment under share appreciation rights only if you work with us for 2 years, means there is 2 additional year of service condition that the service condition that the employee has to satisfy, and because there is 2 year service condition, we will recognize the expense under share appreciation right over period of 2 years. So same logic, you will recognize the expense as and when the employee renders services. If the service condition is already satisfied, if the employee is not expected to provide any further service and the share appreciation rights or the share based payments have already been vested, then the expenses will be recognized immediately. Let's now take an example and understand a cash settled transaction. Now here we are talking about a payment based on the share price. Okay, so say for example we have number of employees 100 standard, okay, and each employee is entitled to, let us say, 10 shares. How much? 10 shares, and it is cash settled after 3 years. So after 3 years, whatever is the share price, that multiplied by 10 will be paid to each employee, and assume for a moment all the 100 employees will continue to remain in the organization. Okay, so year 1, year 2 and year 3 years, and fair value at grant date is say 90 rupees. Now whenever there is a cash settled transaction, the fair value on grant date is not relevant, because that is not the basis on which you will pay the amount to the employees. You will pay the amount to the employees based on the fair value at the end of 3 years, and we have also understood that in case of a cash settled transaction, you will remeasure the liability at the end of each year. Now to determine the expense for year 1, we have to see how many employees are there, 100, how many shares per employee, 10, so total 1000 shares. For expense of year 1, we have to see what is the fair value of share at the end of year 1, because assume you have to settle the transaction at the end of year 1, how much would you have paid? That is determined by the fair value at the end of year 1. So you have to know what is the fair value at end of each year. Say fair value at the end of year 1 is 95. Say this is 95. Say the fair value at the end of year 1 is 95. Okay. So total estimated liability. How much will be the total estimated liability? Number of employees 100 multiplied by shares per employee 10. So you will issue 1000 shares multiplied by fair value 95, you get 95,000. So the company expects that there will be a cash outflow of 95,000 considering the fair value at the end of year 1. Now is this 95,000 expense for 1 year or for 3 years? This is an expense for 3 years. So expense to be recognized is 95,000 divided by 3, which comes to 31,667 rounded off, or 666.67. Okay. So 31,667 is the expense to be recognized for year 1. And what is the cumulative expense recognized? Cumulative expense recognized is also 31,667. Okay. Now, what is the entry for this? Debit, employee benefit expense, credit, share based payment liability, or share based payment payable. So debit 31,667 and credit 31,667. Come to year 2. Let us say fair value at the end of year 2 is 98 rupees now. Is 98 rupees. Now if it is 98, what is the estimated liability? 98 multiplied by 100 multiplied by 10, 98,000. This 98,000 is expense for 3-year period. Now what should be the cumulative expense recognized? 98,000 divided by 3 multiplied by 2, you should recognize cumulative expense of 65,333, correct? So how much of expense will you recognize in year 2? See, cumulative expense should be 65,333. Out of this, you have already recognized 31,667. So 65,333 minus 31,667, you will get 33,667 to be recognized in year 2. I am repeating once again. In year 1, you have cumulatively recognized 31,667. At the end of year 2, you should cumulatively recognize 65,333. Okay, and you have already recognized 31,667 in year 1. So the difference that should be recognized is 33,667. So this 33,667 is nothing but cumulative expense to be recognized minus cumulative expenses already recognized. So if you want, you can just make a note here saying that this expense to be recognized is nothing but cumulative expense till end of current year minus cumulative expense recognized till end of previous year. Okay, you can write that, or to simplify this, maybe you can move this cumulative expense recognized row above and expense to be recognized below. Either way, it is fine, right? So what will be the entry? 33,667 debit and 33,667 credit. And year 3, assume for a moment the fair value comes down to 90. Fair value comes down to 90. So how much will be the expected liability? 90 multiplied by 100 multiplied by 10, which is 90,000. How much of expense will be recognized? Cumulative expense, entire 90,000. How much is already recognized? 65,333. 90,000 minus 65,333, you get 24,667. So 24,667 will be recognized in year 3. Cumulatively, if you total this up, the total expense recognized is 90,000. So when payment happens or when settlement happens, you will say debit SBP liability, credit bank, how much? 90,000 and 90,000. Okay, so this is how you will account for a cash settled share based payment. Now this is not an appreciation right. Appreciation right will come to separately using an illustration given in the study material. This is purely a share based payment transaction. Let's now have a look at another question which is based on share appreciation rights. And as I have told you earlier, basically the employer tells the employees that whatever is the increase in the share price, we will pay you an amount in the future. Now the thing that you have to understand here is, say we are standing today and we tell the employees that we will pay you the appreciation after 2 years. We will pay you the appreciation after 2 years. And we actually do not know what will be the value of the shares after 2 years and what will be the appreciation amount that will be payable. So this share appreciation rights, what we are required to do is we are required to calculate the fair value of these rights as at the initial recognition date and as at the end of every period. That is what we are required to do. So basically, what is the fair value that you attribute to the rights that you are giving to the employees? That is what we have to decide. That will be done using some option pricing model. Again, option pricing model is not required to be applied in the questions. The question will tell you what is the fair value. So when I say that the fair value of a share appreciation right is, say for example 100, what I am telling is for the payment that I will be making after 2 years, from now, the value attributable to that payment or the fair value of that payment is 100 as of today, and based on that we will do the accounting. So let's have a look at this question. XYZ issued 10,000 share appreciation rights that vest immediately to its employee on 1st of April of 20. So, on 1st of April of year 0. So, on 1st of April of year 0, when the entity has granted the share appreciation rights, that day itself the share appreciation rights have vested. Now, what is the meaning of share appreciation rights have vested? It means that there are no vesting conditions. All the vesting conditions, all the services have already been provided, and hence there is no further obligation on the employees to provide any service. Meaning to say, the entity will not receive any service in respect of these payments. So, if the entity will not receive any service in respect of these payments, that means the service has already been received. We will assume that the entity has received the service and will recognize the expense immediately. When will we recognize the expense? On 1st of April of year 0. Okay. The SARs will be settled in cash. So, the share appreciation rights will be settled in cash. Using an option pricing model, at that date, it is estimated that the fair value of a SAR is 95. So, the fair value of a share appreciation right is 95. Meaning to say, what is the expense? 95 multiplied by 10,000, 9,50,000 is the expense to be recognized immediately. Then, the SAR can be exercised any time up to 31st March of year 3. So, the right with the employee can be exercised at any point of time up till 31st March of year 3. So, basically the employer is giving an option to the employee, whenever the market goes up, whenever the market is at a high, whenever our share prices go up, you can exercise. That is your choice. Employee has a right. Employee has a right to exercise whenever the employee wants. Okay. At the end of period 31st March of year 1, it is expected that 95% of the total employees will exercise the option. At the end of year 2, 92%. Then 92% of the employees will exercise at the end of next year, and finally 89% will exercise at the end of third year. Now you might be wondering, why would someone not exercise these options? Maybe they have forgotten, or maybe they have been waiting. They kept on waiting that the share price will go up and go up, and ultimately they missed out. Okay, or due to some other circumstances they did not exercise. Maybe some of them passed away in this period. For whatever reasons, they did not exercise these options. Ultimately, only 89% were exercised at the end of the year. Now, the thing that you have to understand here is 89% of 10,000 works out to 8,900. To this 8,900, whatever is the price as on 31st March of year 3, you will pay the amount, that is 114. 114 per share multiplied by your 8,900, that is the final outflow from the entity side. Now, how do we reach to this final outflow? We'll understand once we prepare the tabular solution. Okay. The fair value at the end of each period is given below. As on 31st March of year 1, 112, then 109 and 114. Now, what is the meaning of this fair value of SAR? The fair value of this appreciation rights basically mean that, say for example, we are on 31st March of year 3. When I say the fair value as on 31st March of year 3 of this share appreciation right is 114, indirectly I am saying for each right the employee will receive 114. If the same was exercised at the end of year 2, the employee would have received 109. If the same was exercised at the end of year 1, the employee would have received 112. Okay, so that is the meaning of the fair value. So when you as an employee hold this right, you can claim 114 from the company at the end of year 3. That is what is the fair value of the share appreciation right. Okay. So what are we required to do? We are required to calculate the expense for each year, and we are required to journalize the entries. Now again here this is a simple question. We just need to approach it logically and see how we will account for the cash based payment. Okay. So let's put the years here. Okay. First is on 1st of April of year 0. Okay, that is the date on which we have granted. On the same date, the share appreciation rights have vested. So, entire expense will be recognized on that date. Now, the expense will be recognized considering what? Considering the fair value of the equity instrument granted. What is the fair value of equity instrument granted? They have mentioned it to be 95 rupees per share, and accordingly we will provide for the expense. Okay, so then first restatement will happen on 31st of March of year 1. Then 31st of March of year 2, then 31st of March of year 3. Okay, these 3 dates the restatements would happen. Now how many stars have been granted? If you see, the number of share appreciation rights that have been granted is 10,000. Okay, this is the total share appreciation rights. Now what is the expectation? See, on the date of grant, you expect that all the employees will subscribe or all the employees will exercise the rights. So on this date, it will be 100% expectation. We expect that 100% of the rights will be exercised. They have already been vested. There is an expectation that 100% rights will be exercised. Okay, so number of rights will be 10,000 multiplied by 100%, that comes to 10,000. So all the rights will be exercised. Fair value, what is the fair value? What is the fair value? Fair value is given to be 95 rupees. So 95 is the fair value. So the expense will be 10,000 multiplied by 95, that comes to 9,50,000. This expense will be recognized in the income statement or in the P&L. This expense of 9,50,000 will be recognized immediately. Then on 31st March of year 1, what is the expectation? The expectation is that 95% will exercise. So 95% will exercise. So how many rights will be exercised? 10,000 multiplied by 95%, that comes to 10,000 multiplied by 95%, that comes to 9,500, and fair value on that date is 112. Okay, so the total expense or the cumulative liability, I will put it as liability. Okay, cumulative liability will be 10,64,000. Now, how much should be the expense? The expense at 1st of April of year 0 will be entire 9,50,000. Now, the estimate of liability, the fair value of liability has increased from 9,50,000 to 10,64,000. Now, when there is an increase in liability, what will you do? You will also increase the expense, you will also book an expense. So, the difference of this 1064 minus 9,50,000, 1,14,000 of additional expense has to be booked as on 31st March of year 1 because you have remeasured the liability. Then moving on 31st March of year 2, we expect that 92% of employees will exercise the option. So, this will be 92%, which means it is 10,000 multiplied by 92%, that comes to 9,200, and now fair value has come down 109. Okay, now what does this mean? Number of shares also going down and fair value also going down means the liability is reduced. Okay, now what will be the liability? 109 multiplied by 9,200, the liability will be 10,02,800, and there is a reduction of 10,64 minus 10,02,800, reduction of 61,200. Now there is a negative expense, means what? We will have to credit the employee expense account. Okay, and lastly, how many exercised? Finally 89% was exercised, so this is 89%. Okay, number of rights will be 8,900, then fair value is 114. So the liability now will be 114 multiplied by 8,900, that is 10,14,600, and there is an increase in liability, that is 11,800, that has to be booked as an expense. So your entries will be on 1st of April of year 0, employee benefit expense debit to SBP, share based payment liability. Please note, if it is a cash settled transaction, you have to create a liability and not credit it to equity. What is the amount? Amount is 9,50,000 debit, 9,50,000 credit, that is first. Then on 31st of March of year 1, there is an increase by how much? 1,14,000. So same entry, you will say 1,14,000 debit and 1,14,000 credit. Then on 31st March of year 2, there is a reduction in expense. So you will debit the liability, SBP liability, because the liability has reduced. Please see here, liability has reduced from 1064 to 10,02,800, a reduction of 61,200. So you will debit the liability, credit the expense. Sir, how can we credit the expense? See, those golden rules of accounting, debit, expense, credit, income is for a foundation level. In real life, if there is a reduction in expense, you will have to credit the expense. If there is a reduction in income, you have to debit the income. Okay. So, SBB liability, debit 61,200. So, let me just put a negative number here, 61,200 to employee benefit expense 61,200. And friends, you can have negative items even in expenses account. Okay, so that is not the thing to be worried about. And lastly, on 31st March of year 3, employee benefit expense debit, how much? 11,800. 11,800 and 11,800. Now, these are the expenses which we have booked in each of the year. Now, what will happen on 31st March of year 3? All these 8,900, all these employees who are entitled to 8,900 rights, they will come to the company and say, we have the rights, please pay us the amount. So, the amount has to be paid. What is the amount to be paid? The amount to be paid is 8,900 multiplied by 114, 10,14,600. What is the journal entry? I don't think I need to pass this journal entry. You can do it on your own. SBB liability debit to bank account 10,14,600. Okay. For those of you who might think, sir, you have not completed the problem. SBB liability debit to bank credit, that will be 10,14,600 and 10,14,600. Okay. Simple journal entries. What you should be bothered about is how to calculate the amount, and no confusion even in calculation of amount. Very straightforward. Because the share appreciation rights have already vested, on the date of vesting you will recognize the entire expense based on the fair value of the share appreciation rights. And at the end of each reporting period, you will see what is the change in liability. And based on the change in liability, you will either increase the liability and increase the expense, or reduce the liability and reduce the expense. Very simple question. Now, so far we have understood about equity settled transactions and cash settled transaction. Equity settled transaction is where equity instruments would be issued and hence you will debit expense or an asset and credit equity. And cash settled transactions are where cash payment would be done or other assets would be transferred. So, you will debit the expense or an asset and credit a liability. Now, sometimes what happens is there could be share based payment transactions which gives an option to the other party to either take cash or to take equity. When I say cash, cash and other assets, or to take equity. Say for example, there is an employer who tells the employee that after 2 years of service, either you take 100 shares of the company or take value of 100 shares in form of cash, right? So, in such cases, we say that there is a share based payment with cash alternatives. Now, in this case, we said the employee has an option. Similar option can be retained by the entity as well. So, the entity may have an option and the entity may decide either they want to issue equity instruments or they would transfer cash or other assets. So, in any case, there are share based payment transactions which have cash alternatives. Now, if you carefully look at these transactions, there are two things which are happening here, or there are two things which are possible. One, equity instruments may be issued. Number two, there could be a liability which has to be settled because it is a cash settled transaction. So, it is a kind of a compound instrument, a compound financial instrument having both equity component as well as a liability component. Now, how do we account for these transactions? To understand the accounting for these transactions, we will divide the discussion into two categories. One, where the other party have an option. Second, where the entity has an option. The first case is where the other parties have an option. So, the other parties will decide whether they want to take cash or whether they want to take equity. In the second case, the entity decides whether it wants to issue equity or it wants to transfer resources, right? Now, coming to the first category where we say the other party has an option. Now, that other party may be an employee or any other third party. The other party may be an employee or any other third party. Now, in this case, how do we recognize the share based payment transaction which has cash alternative? Now, when it comes to employee, the first thing that we have understood is that the value of services will be the fair value of equity instruments to be issued or fair value of the liability which is determined, right? Because the services cannot be valued. We cannot value the services reliably. So, we rely on the fair value of the equity instruments. Now, here when there is an option with an employee to either take cash or to take equity instrument, what the standard says is, first determine the fair value of the liability option. First determine the fair value of liability option. Then determine the fair value of equity option. Then determine the fair value of equity option, and the fair value of liability option will be considered as the liability component, and the difference between the fair value of liability and the fair value of equity instrument will be considered as the equity component. So what do I mean by that? So say for example, the entity gives an option to the employees to take 1000 share appreciation rights or to take 1100 share options. These are the two options given to the employees, and assume for a moment the fair value of both the options is rupee 1. Okay, fair value of both the option is rupee 1. Now the employee may decide to either take 1000 share appreciation rights or to take share options after, let us say, 2 years period. Now the key question here is, how should we account for this transaction? So here what you have to do is, you have to first determine what is the liability component. Which one is the liability component? The share appreciation rights, which will be cash settled, that is a liability component. So for 1000 multiplied by 1000 rupees is the liability component. Then what is the total value of the equity component? 1100 multiplied by 1100 is the equity component. So the standard says 1000 is the fair value of liability for which liability has to be created, and the difference between the equity value and the liability value or the liability component, the difference of 100, that is the equity component, or that will be the equity settled transaction. So your expenses will be debited by 1100, whereas liability will be credited by 1000 and equity component will be credited by 100. So to summarize, when an employee has a choice under a share based payment with a cash alternative, the approach that you need to follow is, first determine the value of liability component, then determine the fair value of the equity alternative, and the difference between the fair value of the liability component and the fair value of the equity alternative will be the equity component, right? So whatever is the liability component will be credited to liability, and whatever is the equity component will be credited to equity. Now on the settlement date, two things are possible. The first possibility is the employee asks for cash or other assets, meaning to say this share based payment with cash alternative actually becomes a cash settled transaction. Now in that case, whatever is the liability, that will be paid off. So you will debit the liability and credit bank. Whatever is the equity component will remain in equity. There is no reversal required. You may transfer from one component in equity to another component in equity, but there is no reversal required. So on the settlement date, say for example, the fair value of the SAR remains to be rupee 1. So on the settlement date, the employee will take 1000 rupees. You will debit liability by 1000 and credit bank by 1000. So liability becomes 0. What happens to the equity component of 100? That equity component of 100 will remain in the equity itself. Okay, so that is the first scenario. The second scenario that is possible is that the employee wants the shares. The employee wants the shares or equity instrument, and now the entity has to issue equity instrument. Now when the entity issues equity instrument, it is issuing equity instrument worth 1100, assuming the fair value remains to be 1. So in that case, whatever is there in the liability account will be transferred to the equity component, maybe share capital or securities premium, whatever it is, it will be transferred from the liability account to equity component. Whatever is the equity component will remain in equity component, and instruments or shares will be issued to the employees. Now you might have a question, sir, because the employee gets more shares under the shares option, will he not exercise the option to take shares? See, a lot of them who have maybe who are well versed with the markets, who want to hold shares and all of that, they may want to take shares. But for someone who doesn't deal in shares, who doesn't want to take shares, who will open the demat accounts and pay annual maintenance charges and all of that, for them they will say, okay, I'm getting some less cash, let me take the cash and maybe put in some FD or something like that. Okay, so it purely depends on the individual, because if they take the shares, they take the delivery and then they have to sell it, then there will be capital gains, file the returns, so much of complexities. So employees may still choose a cash alternative even though it is in lesser value. So the entity will not think that because the equity settlement is beneficial, so it is likely that the employee will exercise the equity option, so let me account it as an equity transaction. That is not what it is done. At the date of recognition, you will determine the value of the liability component, you will determine the fair value of the equity alternative, and the difference between these two will be the equity component. So your expense will be the sum of liability component and equity component. In our example, 1000 was the liability component, 1100 was the fair value of equity alternative, 100 is the value of equity component, and the expense is 1000 plus 100, 1100, right? This is a simple example for us to understand the treatment when employee has an option under SBP with cash alternative. Now you might get a doubt, sir, what if there were 1000 share appreciation rights and 1000 equity share options? So the fair value of the cash settlement alternative or the liability component is 1000 and the fair value of equity alternative is also 1000. In that case, what will be the value of equity component? I think by now you have the answer. 1000 minus 1000, the value of equity component will be 0. Nothing will be recognized under equity component. So that is one thing that you need to keep in mind. Okay. Now this is when we have transactions with employees. What if we have transactions with third party? Say there is an entity and there is a supplier. Okay, supplier will supply some goods. Now tell me one thing. At what value will you recognize the transaction? We have understood that whenever there is a transaction with a third party, you will consider the fair value of goods to recognize the transaction. So the value of the overall value of the transaction, or the value at which you will record the transaction, or the inventory, or the expense, or the property, plant and equipment, that will be the fair value of goods and services received. So say for example, the supplier is supplying goods which has a fair value of 10,000. So 10,000 is the value that you will book under inventory. Inventory debit 10,000. Now again here, assume for a moment that the supplier has an alternative. If they want shares, they can take shares, or if they want equivalent cash, they can take equivalent cash. Now even here, first you have to determine the fair value of the liability component. You have to determine the fair value of liability component. So say fair value of liability component comes to 8,000. The difference between 10,000 and 8,000, the 2,000 of difference will be considered as equity component. So you will debit inventory by 10,000, to liability 8,000 and to equity component 2,000. Now friends, once you have recognized a liability component as well as an equity component, please keep one thing in mind, that for the liability component, which is a cash settled transaction, you will have to remeasure the fair value at the end of each reporting period till the time of settlement. So at the end of each reporting period and on the date of settlement, you will have to remeasure the fair value, and any difference in the liability or any difference arising on account of changes in fair value will be recognized in the P&L, right? So if the liability value increases, you will have to debit the P&L. If the liability decreases, you will have to credit the P&L or credit the corresponding expense. Okay, so that is one more thing you have to keep in mind, that for the liability portion, you have to treat as if it is a cash settled transaction. Now even with a supplier, on the date of settlement, if the supplier says, okay, I want cash, then you pay cash and settle the liability. What will you do with the equity component? Equity component will remain in equity, and the simple reason being, both in case of employees and other parties, when they choose to take cash, they are foregoing the equity option. Okay, when they are saying we'll take cash, they are also saying we will not take the equity option. So whatever is recognized under equity will remain in equity. That is the first thing. Now on the due date, if the supplier wants to take equity, then whatever is the liability balance will be transferred to equity component, and you will credit maybe the share capital and securities premium account appropriately. Okay, so this is how you will account for transaction where the other party has an option either to take equity or to take cash settlement. Now to summarize the entire story, when other party has the option to choose if they want to take cash or they want equity instrument, we will have to divide the discussion into two parts. One, if the other party is an employee. Two, the other party is any other third party. In case of employees, first you will determine the fair value of the liability component. Then you will determine the fair value of equity alternative, and the difference between these two will be credited to equity component or will be considered as equity component. On the date of settlement, if the employee takes cash, then the liability is exhausted, cash is paid out, and if on the due date the employee takes equity or employee demands for equity instruments, liability will be transferred to equity. That is the first part. And friends, please note, for the liability part, at the end of each reporting period, and on the date of settlement you will do a fair value measurement and the difference being recognized in the P&L. Coming to other parties, as far as other parties are concerned, you will determine the fair value of the goods or services. From that you will deduct the fair value of the liability component and balance will be recognized in equity. Even here on the date of settlement, if cash is taken, then liability will be 0, then liability will be exhausted by paying cash or transferring other assets. If equity is issued, then the liability will be transferred to equity. Even here for the liability part, you will do a remeasurement at the end of each reporting period and on the date of settlement, right? So this summarizes the discussion where there are share-based payment transactions with cash alternative. I know it has been a lot of theory. Let us take one example, solve it and then understand the implications of whatever we have discussed. Let's now have a look at a question where there is a share-based payment with cash alternative and the other party has the option to exercise that, right? So on 1st of January of year 1, ABC Limited gives option to its key management personnel employees to take either cash equivalent to 1000 shares or 1500 shares. So either you take cash equivalent of 1000 shares or take 1500 shares. Now you might immediately jump into a conclusion saying that let us take 1500 shares. But wait, let's read on. The minimum service requirement is 2 years, so you have to work for 2 years and shares being taken must be kept for 3 years. So see the catch here. Though you will get more number of shares, you have to keep the shares, you have to hold those shares for 3 years. So this is where people would decide maybe not to take shares but rather take cash and run away. Okay. So fair value in rupees of the shares are as follows. Share alternative fair value with restrictions 102. What does this mean? The alternative, the fair value of shares with the restriction, that is you have to hold for 3 years, it is 102 and grand date fair value on 1st of January is 113. Now, two things that you have to keep in mind. The first thing is 102 is the fair value of the shares alternative. That is when you take the shares and if you have to keep it for 3 years period, the fair value is determined as 102. But if you have to take cash, the fair value of the cash alternative is 113. Now, why this difference? See, the difference is there because in this 102 there are some restrictions. So whenever there are some restrictions attached, generally the market discounts the value. The market pays lesser amount where there are some kind of restrictions involved. So if you have lock-ins involved, then the share price will be automatically lower. Okay. Versus if it is a normal share, if there are no restrictions, then the fair value is 113. Okay. Now why are these two important? These two are important because the share alternative gives us the value of the equity alternative and the grand date fair value will give us the value of the liability component. Okay, we will put numbers, we will put the relevant numbers and see how the competition goes. One thing that I wanted you to understand here is whenever there are restrictions, say for example there is a share with a differential voting, right? Generally the price would be lesser as compared to a normal share. Okay, so even here because there are restrictions, the fair value of the equity shares is lesser with restrictions. If there are no restrictions, then the fair value is 113. Okay, then fair value on 31st December of year 1 is 120 and on 31st December of year 2 is 132. Okay, now the employees exercise their cash option at the end of year 2 past the journal entries. Now in this question there is a 2-year service period, meaning to say we have to recognize expense in year 1 and year 2, that is on 31st December of year 1 and 31st December of year 2 we have to recognize the expense. But we have also understood that for equity settled transaction the value on the grand date is relevant and for cash settled transaction anyways we will do a remeasurement, so whatever is the value at the end of the reporting period that will be relevant. And it is a transaction where there is an equity alternative and also a cash alternative. Let us see how do we recognize this transaction, how do we pass the necessary journal entries. Now in this case there is a share based payment transaction with cash alternative and who has the option? Employee has the option. So we have to determine what is the liability component, we have to determine what is the equity component. So let us write down the details. Let's write down the data, particulars. Okay, date, number of shares, fair value per share, total fair value. Okay, now the first is the cash alternative. What is the cash alternative? Cash alternative is for 1000 shares. It is for 1000 shares. So the employees can choose to take cash, for which the fair value as per the question is 113. So on 1st of January of year 1, that is your grant date, the fair value per share for the cash alternative is 113. So the total fair value comes out to 1,13,000. Then for share alternative or equity alternative, on the grant date, number of shares 1500, and what is the fair value? The fair value is given to be 102. So 102 is the fair value. So the total fair value comes to 1,53,000. So this is your liability component. 1,13,000 is the liability component. This is the fair value of equity alternative. What is the meaning of fair value of equity alternative? If I don't want to take cash, but I want to take equity, the fair value is 1,53,000. Okay. Now, what the standard says is, you first determine the fair value of liability component, which we have determined at 1,13,000. And please note friends, whenever there is a transaction with the employee, the determination of all of these values should be based on the grant date. It should be based on the grant date. So, the cash alternative is valued at 1,13,000 and the equity component alternative has a value of 153. So, the difference between these two is the equity component. So, equity component works out to 40,000. Now, we know there is a liability component, there is an equity component. Now, this liability component and equity component has to be accounted for over a period of 2 years, right? Now, listen to me very carefully. As far as equity component is concerned, I know it is 40,000. For 2 years means each year I will have to account for 20,000. Will the value change? The value will not change irrespective of change in the fair value of the shares. But when it comes to the liability component, when will we do the first recognition or when will we pass the first entry? At the end of the first year. And we know that the liability component or cash settlement alternative has to be remeasured at the end of each reporting period. So, we will not account considering 1,13,000. We will account for the cash settlement alternative considering the fair value as on 31st of December of year 1. Okay, so as far as equity component is concerned, you will have expense of 20,000 in year 1 and you will have 20,000 of expense in year 2. So, this is 31st of December of year 1 and this is 31st of December of year 2. 20,000 and 20,000 will be expense based. 20,000 and 20,000 will be the expense for the equity component. Okay. This value will not change because for equity component we do not restate, we do not remeasure. But for cash settlement alternative, we have understood that at the end of each reporting period, we will have to do the remeasurement. So, for the liability component, we have to work out what will be the value as on 31st December of year 1 and what will be the value as at end of 31st of December of year 2. So, for the liability component, that is for 1000 shares, we have to see what is the fair value at the end of each period. Okay. So, fair value as on date 31st December of year 1 is 120 and 31st December of year 2 is 132. So, 120, 132. Okay. Expected liability is 120 multiplied by 1000 shares, that is 1,20,000, and 132 multiplied by 1000 shares, 1,32,000. Okay. Now, this 1,20,000 is for a 2-year period. Also, the 1,32,000 is for a 2-year period. So, accordingly, you will have to expense the proportionate amount. So, cumulative expense will be how much? 1,20,000 divided by 2. So, 60,000 should be the cumulative expense that will be recognized at the end of year 1 and 1,32,000 will be the cumulative expense that you will recognize at the end of year 2. Okay. Expense recognized, expense already recognized 0 and here you have already recognized 60,000. Balance expense 60,000 minus 0, 60,000 and 132 minus 60,000, 72,000, right. So, this will be the expense in each year 60 and 72 and for equity component 20 and 20. So, based on this, let us pass the journal entries. 31st of December of year 1. So on 31st December of year 1, how much is the liability? SBP liability is 60,000. And what is the equity component? SBP reserve under equity, it is 20,000. Where do we get this 20,000 from? This part, right? So the expense will be employee benefit expense debit will be 80,000. 60 plus 20, 80,000. Then on 31st of December of year 2, SBP reserve will be 20,000. Liability for SBP will be 72,000. And the total expense will be 20 plus 72, 192,000, right? So this is how you will pass the entry as at end of 31st December of year 1 and as at end of 31st December of year 2. Two things that you have to keep in mind is that for the equity portion or for the equity settlement part, you will not do any kind of revaluation or you will not remeasure the fair value. For the liability part, you will remeasure the fair value at the end of each reporting period and on the date of settlement. Now the question says that on the date of settlement, the employees exercise their cash option. Meaning to say, what will the employee get? The employee will get a total value of 1,32,000, which is nothing but 132 multiplied by 1000. That is what the employee will get. Will the employee get any shares? They will not get any shares because they are giving up their rights to receive shares and instead they are taking cash, right? So this 1,32,000 is nothing but liability recognized here 60,000 and liability recognized here 72,000. So on the date of settlement, 31st December of year 2, you will say as liability of for SBP, that is 1,32,000 to bank 1,32,000. Now, will I reverse the equity component of 40,000 which I have recognized as expense? I will not do that. It will remain under equities only. You may move from one component to another component, but you will not move it out of equity or you will not reverse it. It is not that because the equity shares are not being issued, then we will reverse the expense and will credit it to P&L. That is not allowed. Okay, that will not be done. It will remain in equity. It is like an option which was with the employee, which the employee has not exercised and hence it is being forfeited and there will be no transfer back from equity component to the P&L. That is one more thing you have to keep in mind. So to quickly summarize, as at the date of grant, the cash alternative had a value of 113 and the share alternative had a value of 102. And why was the share alternative lesser? Because there is a lock-in involved. And based on that, the fair value of the equity alternative, that is the total fair value of the equity option was 1,53,000 and the liability component had a value of 1,13,000. The difference between these two, that is this 40,000, is considered to be equity component. This 40,000 is expensed over 2 years period, 20,000, 20,000. Then come to liability component. We are not recognizing the expense based on 113 because on the date of recognition, the fair value has increased to 120. So for us, liability will be determined based on 120. So for 120 fair value, the expected liability is 120. That is for a 2 year period. So for 1 year period, it becomes 60,000, right? So you'll recognize 60,000. Then in the next period, 132 is expected. And because you have already recognized 60, balance 72 will be recognized. So based on this, we'll pass this journal entry and this journal entry. And because the employees have opted for cash option, you will settle the liability by paying 1,32,000. A very simple and logical approach, just that you need to understand the flow of transactions. Let's have a look at another question, and this question is similar to the one that we have just now solved. Tata Industries issued share-based option to one of its key management personnel which can be exercised either in cash or equity, and it has following features. So the company is entering into a share-based payment arrangement and it can be either settled in cash or in equity. What is the first option? Cash settles shares. So you can settle the shares in cash, and for which you will get 74,000 shares. Otherwise, and for which the service condition is that you have to be in the service for 3 years. Then second option is number of equity settled shares of face value 100 each, you will get 90,000 shares. So 74,000 cash settled shares or 90,000 equity settled shares. For second condition, there is a service period of 3 years, that is the vesting period, and and there is a restriction to sell for 2 years. Equity price with a restriction to sale for 2 years, that is at the initial date or the grant date is 115, that is the fair value as on the grant date for the share based option, that is 115. Fair value at the grant date is 135 without the restriction. Then they have given fair value at the end of year 0, year 1 and year 2. When was it granted? It isn't mentioned, so we can assume that it was granted on maybe 1st of January of year 0 or any other grant date which is relevant. Okay. Now considering this information, we have to pass necessary journal entries. Now friends, so far in all the questions that we have done, we have done a detailed calculation or a detailed working for our understanding. Now that we have got used to the detailed way of working, let us try to work out this question in examination condition or the way we would want to present it in the examination. In exams, you are not expected to give a very detailed solution. Okay, we need to know how to work out the numbers, and quickly we should be able to arrive at the numbers and get to the solution. Now, the first thing that we need to determine is the liability component. For how many shares? Cash settled shares is 74,000 and the fair value for the cash settled shares is 135. So, liability component is 74,000 multiplied by how much? 135. So, if the employee choose to take cash, the fair value of that is 135 multiplied by 74,000, which is 99,90,000. Okay. Then what is the fair value of equity alternative? Under equity alternative, you get 90,000 shares and this have a fair value of 115. Okay. So, 90,000 multiplied by 115, you get 1,03,50,000. So, what is the value of equity component? That is, what is the differential value of the equity component? Value of equity component is 1,03,50,000 minus 99,90,000, you get 3,60,000. Now, the way you have to understand this is, the liability component, if the employee chooses for cash settlement, has a fair value of 99,90,000. If the employee chooses equity settlement, then the alternative value of that equity settlement, then the fair value of the equity alternative is 1,03,50,000. The differential represents equity component. Okay. Now, what is the service condition? Service condition is 3 years. So, expense per year for equity is how much? 360 divided by 3, 1 lakh. 360 divided by 3, 1,20,000 will be expensed in each year. That is for the equity component. Now coming to the liability component. Okay. Now if you look at the liability component, how many shares are there? There are 74,000 shares and we have to take fair value at the end of each year to recognize the liability. So number of shares 74,000, right? Then fair value 31st of December of year 0, 31st of December of year 1, 31st of December of year 2. Fair value is given to be 138, 140 and 147, 138, 140, 147. Okay. Then cumulative, then estimated liability. What is the estimated liability? 74,000 multiplied by 138. So, the estimated liability is 1,03,60,000, that is nothing but 74,000 multiplied by 140, and lastly 74,000 multiplied by 147, you get 1,08,78,000. Okay. Then cumulative expense to be recognized. So, at the end of year 1, how many years expense will you recognize? See, the service condition is for 3 years and this 1,02,12,000 is the total expenses for 3 years. So, for the first year, what will be the cumulative expense? It will be 1/3, it will be 1/3, this one will be 2/3 and this one will be 3 out of 3, that is the full amount. Okay. So, it will be this divided by 3, you get 34,04,000. Okay. Expense already recognized is 0. Then for the second period it is 1,03,60,000 divided by 3 multiplied by 2, you get 69,06,667. Expense already recognized is 34,04,000. So, balance to be recognized. Here the entire amount, this minus this. Here 69 minus 34, 35 lakhs will be recognized. and at the end of the 3 years, entire 1,08,78,000 should be the cumulative expense. Out of that, already recognized is 69,06,667. So the balance of 39,71,333 will be recognized in the current period. Okay. Now we have determined what is the liability component or expense towards liability component to be recognized, that we have done right. Now to this we'll add equity component, which is 1,20,000 each year, right. So you will get total expenses to be recognized. How much? 34,04,000 plus 1,20,000, 35,24,000, then 35,02,667 plus 1,20,000 and 39,71,333 plus 1,20,000. What will be the entry? You will debit employee benefit expense and you will credit SBP liability and you will credit SBP reserve. Okay. So basically I am saying employee benefit expense account debit to SBP liability to SBP reserve. Okay, that's how we can pass the entries. Even if you write this, this is a valid way of writing entries. In fact, once you qualify, this is how you will be passing entries in your ERP systems, right. So employee benefit expense is 3524, 3622 and 4091. SBP liability 3404, 3502, 667 and 3971, and this is equity component SBP reserve 120 each. So if you see the total, you get 1,12,38,000, 1,08,78,000 and 360,000. Okay. Now does the question tell anything about how is it settled? It doesn't say anything. So assume for a moment if it is cash settled, then what will be the entry? The entry will be debit SBP liability by 1,08,78,000, credit bank 1,08,78,000. Okay, if it is cash settled. Okay, if it is equity settled, then the liability will be transferred to equity and you will issue equity shares in turn for that. Now if it is cash settled, will we do anything with this SBP reserve? We will not do anything with this SBP reserve. It will lie under equity. You can move from SBP reserve to maybe general reserve, but it cannot be reversed or it should not be reversed. Now in the same case, if the transaction is equity settled, that is if equity shares are issued to the employees, then in that case what will we do? We will transfer the liability directly to equity. So what you will do is you will debit SBP liability and you will credit SBP reserve. Now this SBP reserve is under equity. Okay. So what will be the amount? 1,08,78,000 debit and 1,08,78,000 credit. That is what you will do. You will transfer it to equity. Now, what is the total balance in equity? Total balance in SBP reserve is 1,08,78,000 that you have transferred now plus 3,60,000 which is already there. Okay. So, the total is 1,12,38,000. Now, against this you will issue shares to the employees. So, you will say on issuing shares, debit SBP reserve equity by how much? 1,12,38,000, credit share capital. Now how much is the share capital? 100 per share is the face value and you will issue 90,000 shares. So 90,000 multiplied by 100 will be your share capital and you will credit securities premium, that is the difference between these two, right? Basically you are saying that you have received services worth 1,12,38,000 from the employees against which you are issuing shares. This is one approach which is possible. The other approach which is possible, and Ind AS is not very clear as to when you issue shares whether you should consider only the liability portion, that is 1,08,78,000 and issue the shares, and balance you keep it as equity under other components of equity, or maybe transfer it to retained earnings. There is no clarity. So I have read enough literature on this. There is no clear cut way or there is no absolute clarity as to what should be the way of accounting. It could be possible that you consider entire 1,12,00,000 as the price, as the value against which you are issuing shares, or this is option 1, or what you can do under option 2 is consider only the liability part which you have transferred to equity, considering that as the value against which you are issuing shares. So basically what you are doing is 1,08,78,000 against which you are issuing shares worth 90 lakhs face value, and the difference goes to your securities premium, which is 18,78,000. Now if you follow option 2, then what you will also do is whatever is the balance in reserve, okay, whatever is the balance left out in reserve, you can carry it as SBB reserve or you can transfer that to retained earnings. Okay, it is not very clear as to which method or what process is to be followed, right? So neither the Ind AS gives absolute clarity, nor I have got clarity by referring to other technical guides and other guidance notes in this matter, right? So actually speaking, what Ind AS says is, here this debit liability and credit reserve is basically you are debiting a liability and transferring it to equity. Now under which component of equity should it be classified, that is not given. So I think management has to take a conscious call, and accordingly they will have to to pass the necessary entries. So in the second option, as I told you, you will also debit SBP reserve, credit maybe retained earnings or other components of equity, right? So by what amount? Here you will do whatever is left, that is 3,60,000 which is left over, debit here, and 3,60,000 which is credit here. Okay, Institute has followed this method, which is option 2. Option 1 is also equally valid, and as I told you, there is no clear cut guidance as to what has to be done. It has to be done considering the facts and circumstances of it, has to be done considering the management judgment. If you ask me, option 1 looks more logical because this is the amount of expense, this 1,12,38,000, that is the total expense that you have recognized. So against that you are issuing shares, that should be the value at which you should be recording the share capital and securities premium, right? If you look at technical guides given by Big Fours and all, they simply say expense to equity, liability to equity. They don't bifurcate into under which component of equity that has to be classified. Let's have a look at another question. Indian Inc. issued 995 shares in exchange for purchase of an office building. Okay, so shares are issued, and what is purchased? Office building, goods are being received. The title was transferred in the name of Indian Inc. on February 2001. So February of year 1, the title is transferred. Now on which date will you recognize the transaction? You will recognize the transaction when goods and services are received. So in this case, goods are received or the property is received in February, so you will recognize the transaction in February. The shares were issued in February. Okay, fair value of the office building was 200,000 and face value of each share of Indian Inc. was 100. So whenever we are dealing with non-employees, the share based payment transactions will be recognized at fair value of goods and services that are received. So in this case, the value that is received is 200,000. So you will recognize the transaction at 200,000. Okay, so fair value of building is equal to rupees 2 lakhs. Okay, so transaction will be recognized at rupees 2 lakhs. Now when I say transaction is recognized at 2 lakhs, what will be the journal entry? Building account debit rupees 2 lakhs. Okay, then 2 equity share capital. How many number of shares are issued? We have issued 995 shares of face value 100 each. So 995 into 100, that is 99,500 will be credit to equity share capital and balance to securities premium. Okay, so to equity share capital 99,500 out of 2 lakhs 99,500 is transferred or is credited to equity share capital account, and balance will be credited to whatever is the balance, that is 1,05,000. This will be credited to the securities premium account, right? So basically what are we saying? We have got buildings worth 2 lakhs and we have issued equity shares. We have issued 995 shares, face value of 100. So face value will be credited to equity share capital and balance will be credited to securities premium account. Let's look at the next question. Reliance Limited hired a maintenance company for its oil fields. The services will be settled by issuing 1000 shares of Reliance. Period for which the service is to be provided is 1st of April to 1st of July, and fair value of the service was estimated using market value of similar contracts of rupees 1 lakh. Nominal value per share is rupees 10. Record the transactions. Okay, so again here pretty simple. There is a service contract for 3 months period and the total value of similar contracts, if similar contracts were taken, that can be a representative of the fair value of the contract, the value would be 1 lakh. So 1 lakh is for a 3-month period. Each month, what is the value? 33,333. Okay, so if you are passing monthly journal entries, what will be the journal entry? So this is a maintenance contract, right? So maintenance expense debit by how much? 33,333. You can say 0.33 also. Then credit what? To, can we say equity share? See, we will issue equity share most probably after the completion of the contract or after the completion of the 3-month period. So we will not issue shares directly, and this is a share based settlement. So we will credit it to share based payment reserve under equity 33,333.33. Okay, like this you will pass being maintenance expenses for April. So similar entries we will pass for the month of May and for the month of June. Okay, so similar amount, same entry will repeat for May and June as well. Then on 1st of July of year 1, the balance in SBP reserve would be rupees 1 lakh. The balance in SBP reserve would be rupees 1 lakh, and against this we will be issuing equity shares. How many shares would be issued? They said they would be issuing 1000 shares. And what is the nominal value per share? 10. So 1000 multiplied by 10, the face value of shares that will be issued is 10,000. Balance 90,000 is towards securities premium. So the entry would be SBP reserve debit rupees 1 lakh to equity share capital rupees 10,000 to securities premium rupees 90,000, right? A very simple entry. So what is happening here? Reliance is getting services. The vendor is providing services to Reliance. Reliance is issuing equity shares in return. The value of service that is received is 1 lakh, against which we are issuing equity shares. So because we are issuing 1000 equity shares, 10,000 is towards the face value, that is the share capital, and 90,000 is towards securities premium. So friends, we have understood the accounting treatment when there is a share based payment transaction with cash alternative, and we have seen cases where the other parties, that is either employees or other third parties, they have the choice at the time of settlement how the accounting has to be done. We have understood that. Now moving forward, the next part of share based payment transactions with cash alternative, where the entity has a choice. Now in the second case we are talking about the entity having a choice on the settlement date whether the entity will issue shares or whether the entity will transfer cash or other assets. Now in this case, how should the accounting be done? Now here what the standard says is, the entity has to check, the entity has to determine whether there is a present obligation for cash settlement. Now what is the meaning of present obligation for cash settlement? It basically means that by looking at the circumstances of the transaction, it is for sure that the entity has to make a cash settlement. For example, if the entity does not have authority to issue further equity shares, now in that case equity instruments cannot be issued. So what is the alternative? You have to transfer cash or you have to transfer other assets. Now in that case we say that the equity settlement does not have commercial substance, meaning to say there is a very remote likelihood that the entity will be issuing equity instruments. In that case, the entity will determine that there is a cash settlement obligation, and hence it will be accounted as a cash settlement share based payment transaction. Means you will create a liability, debit the expense or asset, and you will create a liability. The liability will be remeasured at the end of each reporting period. Subsequently, when the liability is settled, you will debit the liability and credit the bank account. Now in very rare circumstances, if the entity chooses to issue equity instruments because the entity has a choice, then in that case you will transfer the liability part to equity. Okay, that is what is done if the entity determines that the entity has an obligation to settle the transaction in mode of cash or by transferring other assets. If the entity determines that there is no present obligation for cash settlement, then in that case the entity will recognize the transaction as equity settled transaction, meaning to say the entity will debit the expenses or asset and the entity will credit equity, right? Now on the settlement date, multiple scenarios are possible. The first scenario is, now if the transactions are settled in equity, there is nothing much to be done other than transferring the amount from one component of equity to another component of equity. Say for example, from share based payment reserve, you will transfer that to share capital and securities premium. That is what has to be done if the transaction is ultimately equity settled. If the transaction is ultimately cash settled, see, the entity has a choice. The entity accounted for it as a equity settled transaction, but on the settlement date, the entity pays cash or the entity transfers asset. In that case, the standard says it has to be treated as if there is a buyback of equity interest. See, during the course of recognition of expense or recognition of asset, you would have credited equity. Now, on the settlement date, you are paying cash, you are not issuing equity. So, you will debit the equity, which is like a buyback of equity interest, and you will credit cash. So, that is the second scenario. Now, the third scenario that is possible is that the entity decides to go with a higher fair value alternative, meaning to say the entity sees the fair value of cash alternative and fair value of equity alternative, and whichever is higher, the entity chooses that particular alternative. Okay, generally it may not happen, but a scenario like this may be possible. So, what the standard says is, say for example, the fair value of cash alternative is 1 lakh. And the fair value of equity alternative is 1,20,000, and because the fair value of equity alternative is higher, the entity has decided to issue equity shares or go with the equity alternative. Now, in this case, whatever is the difference between the fair value of equity alternative and the fair value of cash alternative, that 20,000 should be recognized in the P&L. Similarly, if you consider the reverse scenario, that fair value of cash alternative is 1 lakh and fair value of equity alternative is say 70,000, and the entity decides to go with the cash alternative, then the difference of 30,000 should be recognized in the P&L, right? So, whenever the entity has accounted for a transaction as an equity settled transaction, and on the settlement date, the entity chooses the alternative with a higher fair value, then the difference between those two fair value should be recognized in the P&L. So, now we have understood that whenever there is a share based payment transaction in which the entity has a choice, we have to determine whether there is a present obligation to settle the transaction in cash. The question is, when does an entity have a present obligation to settle the transaction in cash? So, that is possible, or that could be a case where the settlement in equity instrument has no commercial substance, meaning to say basically the settlement in equity does not have any commercial substance, maybe a case where the entity cannot issue equity instrument, right? In that case, we can determine that the settlement in equity does not have a commercial substance, and hence it will be accounted for as a cash settled transaction. Another case could be where the entity has a past practice of generally settling these kind of transaction in cash, or the entity has a policy to settle the transaction in cash, or whenever the other party, even though they don't have a choice, they come up and say that we want cash, the entity honors them. So, in all of these cases, there is a present obligation that the transaction will be settled in cash, and hence it will be accounted for as a cash settled transaction. So, now let us have a look at an example to understand how exactly will be the accounting when the entity has a choice of settlement and we determine that there is no cash settlement obligation, and hence the entity will recognize it as a equity settled transaction. So, basically this is a SBP transaction, choice with entity and no present obligation for cash settlement, right? So, this is a case where it will not be accounted as a cash settled transaction, but it will be accounted as an equity settled transaction. So, this is the grant date, okay, this is the settlement date. Grant date is 1st of April of year 1, settlement date is 1st of April of year 2, and we have been given fair value under the equity option 1100 and cash option as 900 on the grant date. Now, and on the settlement date, the equity option is 1350 and the cash option is 1450. So, now this is a scenario where the entity will account for this as the equity option. Now, whenever we are recognizing it as an equity settled transaction, what will be the value that we will consider? We will consider the value on the grant date, and assuming that this is for employees, okay. Okay, this is a grant to employees. So, whatever is the date of the grant, you will take the fair value of that date, in which case, in this case it is 1100, and 1100 will be recognized as an expense in the first year. So, for year ending 31st March of year 2, okay, that's 1st of April year 1 to 31st March of year 2, employee benefit expense will be debited by how much? 1100. So friends, please remember, whenever there is a equity settled transaction and the transaction is with the employee, you will consider the fair value on the date of grant, which is 1100. And what will you credit? You will credit SBP reserve under equity, okay, 1100. Now, the employer has the choice, the entity has the choice, and the settlement can be either through equity or through cash. See, at the time of recognition, we have determined that there is no present obligation, and hence we have recognized it as a equity settled transaction. On the settlement date, the entity can decide, okay, I'll give cash or I will give equity shares. Now, say for example, the entity settles the transaction as a equity settled transaction, the entity issues equity shares. Now in that case, the first thing that you have to check is that the higher option or the lower option? What you need to check? Whether the settlement option is higher option or lower option. If it is the lower option, now in this case if I say that the entity decides to settle at equity option, the equity option is less than the cash settlement option. So because the entity has chosen the lower option or the lower fair value option and the entity settles it in equity, there are no further adjustments needed other than moving the amounts from one component of equity to another component of equity. So on settlement, if it is equity settled, the transaction will be, and this date is 1st of April of year 2, and we have assumed in this case 1 year vesting condition or 1 year vesting period, okay. So on this date, what will you do? SBP reserve debit 1100 and you will say to equity share capital and maybe securities premium 1100, okay. So no further adjustments are needed. I am repeating once again, this is a case where there is a share based payment transaction with cash alternative. The entity has a choice. The entity determines that there is no present obligation. So the entity has recognized the transaction as an equity settled transaction. Whenever we recognize a transaction with employee as an equity settled transaction, then you consider the fair value on the grant date and debit the expense, credit equity. So that is what we have done here, debit expense and credit equity, right? Then on the settlement date, whenever the entity has a choice, on the settlement date, whenever the entity has a choice, you have to first check whether the settlement is based on a higher value or the lower value. Now here, equity option is lower, cash option is higher, and because it is settled at a lower value, then in that case, the entity will just debit the reserve, that is the equity, and credit equity share capital and securities premium account, right? That is the first thing. Then, second case is where on settlement, there is a cash settlement which happens. There is a cash settlement which happens. Now, whenever there is a cash settlement which happens, the entity has so far accounted for it as a equity settled transaction. Now, the entity will account for it as a cash settled transaction. The entity will pay 1450 on settlement. Now, on settlement, the equity option is 1350 and the cash option is 1450, and the entity is now settling at a higher value. Now, one thing that you have to remember is whenever an entity settles a transaction at the option which has a higher fair value, then the difference between these two, 1450 minus 1350, this 100 will be your one part of expense. And the other thing that you have to do is, because we are paying cash for a transaction which we recognized as equity, it is like we have purchased back our equity interest. So two things are happening here. First thing is this 1100 of equity, is being bought back. Now when you purchase back 1100 of equity, how much is the fair value? The fair value is 1350. So you will debit equity by 1350 because that is the fair value of repurchase of the equity interest. So what you will do is, you will debit equity by how much? You will debit equity by 1350. Now which component to debit in equity? Maybe SBP reserve and some other component. It could be retained earnings, it is basically a buyback of equity interest, right? So you will debit equity by 1350 and you will also debit P&L, or you will also debit expense 100. Why is this 100 debited? Because you are settling at a higher value, and the difference between those two, that is fair value of the cash option and fair value of the equity option, that has to be treated as an expense. Okay, right? And you will credit to bank 1450. So in other words, what has happened? In other words, what has happened? We have to pay total of 1450. That is what we have decided. Out of this 1450, 1350 is towards equity, because you are purchasing the equity, you are buying back equity, and 100 of extra payment is an expense because we are paying an extra amount, right? So that is the other part. Now, which component in equity and all of that, when we come to financial instrument, we will have more clarity. So I don't want to deliberate much over here because it will result in unnecessary complication. And this example also is outside the book, outside the study material, so that you have some more clarity on how do we handle these transactions, right? That is what is done on settlement. So if it is equity settled, you will just move from one component of equity to another component of equity. If it is cash settled, then it will be considered as buyback of equity, plus if there is any extra amount paid, that is considered as an expense. Okay, I hope you are clear with this. Now let's consider a modified scenario where the fair values on the grant dates are same, but the fair values on the settlement date are different. Now 1450 is the equity option and 1350 is the cash option, right? So here 1350 was equity, 1450 was cash. Now in this case, what will be the difference? The first entry does not change. The first entry will be at 1100, no change in that. On settlement, let us say it is equity settled. Okay. Now, again on settlement date, you have to check whether the option that is being settled, whether the option that is being given by the company or the settlement being made by the company, is it the higher fair value? Now here if you see, fair value of equity is 1450, fair value of cash is 1350. Now, generally, what would a company try to do? Company would try to minimize its outflow. The company would want to give cash because the cash option has a fair value of 1350, and now the company is giving a higher fair value. So this difference will be treated as an expense. This difference will be treated as an expense whenever you settle at an option which has a higher fair value. So the difference 1450 minus 1350 will be an expense. Okay. So now what will be the entry? Here if you see, we have already passed this first entry, employee benefit expense to reserve or equity, and now this extra 100 will also be treated as an expense. So you will employee benefit expense debit 100 to SBP reserve 100. So what happens? First entry of 1100 plus another extra 100, 1200 will be credited to equity reserve, and then when you issue the shares, you will debit the SBP reserve by 1200 to equity share capital and maybe securities premium 1200. Okay, so what has happened here? 1100 is the initial recognition of expense, and the higher value and the difference between the higher value and the lower value, when you are choosing the higher value, will be treated as an expense. Now, in most of the cases, in the second scenario, you will try to go with a 1350 settlement. In that case, if it is cash settled, then debit SBP reserve, that is equity, debit equity by how much? 1350 to cash or bank 1350. Okay, a very simple way of accounting. The only thing that you have to keep in mind is, if you have accounted for these kind of transactions where the entity has a choice as an equity settled transaction, on the settlement date you have to check whether the option that is being settled or the option that is being used has a higher fair value or not. If it has a higher fair value, then the difference between the higher value and the lower value, say for example, it is settled as equity and equity has a higher fair value, the difference between these two will be treated as an expense. So, if equity settled, in this case, equity settled is 1450, cash option is 1350, and because you are settling in equity, that difference of 100 will be treated as an expense. So, you will debit expense and credit equity. Okay. If you settle it for cash, then you will debit. If you settle it for cash, then you are anyway settling it at a lower value, then that difference need not be recognized. Same thing here. If you settle as cash and the equity is 1350, the difference of 100 will be treated as an expense, right? So, you will book that expense accordingly here, right? So, this is how you account for share based payment transactions with cash alternative when entity has the choice. So, let us make quick notes so that we recall these concepts at a a later point in time. You can also make it alongside me. I know we have repeated this multiple number of times, but please note friends, unless you remember, in the examination you might get confused. Okay, so we are talking about what? We are talking about share based payment transactions with cash alternative. Okay, now in cash alternative there are two scenarios possible. Now in these kind of transactions there are two scenarios possible. One, other party has the choice. Other party has the choice. Now that other party can be an employee or other than employee. Now in these kind of scenarios where the other party has a choice, you have to first determine fair value of liability component. Okay, you have to determine the fair value of liability component. For example, a share appreciation right or a cash alternative, whatever is the fair value, you have to determine that. Okay, then you also need to determine, in case of employees, what is the fair value of equity option. So, you are determining the total fair value of the equity option, and here in case of other than employee, you will determine fair value of goods or services. Okay, so for employee you will determine fair value of equity option, for other than employee you will determine fair value of goods and services. From this you will deduct fair value of liability component, whatever you have computed here. So again here also you will deduct fair value of liability component. The balance will be fair value of equity component. Okay, fair value of equity component. Right. Now what you need to remember here is, this is fair value of equity option, that is the total value of the equity option, and if you remove the liability component, the balance represents fair value of equity component. Now whenever you do the accounting, fair value of liability component will be cash settled and fair value of equity component will be equity settled. Okay, so that is how you have to do the accounting for. So you will debit the expense, and for cash settled transaction you will credit liability, and for equity component you will credit equity. For the total value you will debit expense or asset. Okay, a simple structured way to remember this. Now on settlement, if cash settled, then on settlement, if it is cash settled, then debit liability and credit cash. What is to be done with the equity component? You will not touch it. Sir, will this liability component match with cash component? Obviously, because at the end of each reporting period and on the date of settlement, you will remeasure the liability. Okay, so that will how it would match. Then if it is equity settled, then what will you do? You will debit liability and you will credit equity. Okay, this is how you will do. Whatever is in equity will remain in equity. You may move from one component to another component, but whatever remains in equity will remain in equity. This is a case where other party has the choice. Now, if the entity has a choice, then what is the scenario? If the entity has a choice, you have to determine if present obligation for cash settlement. Is there a present obligation for cash settlement? If the answer to this is yes, then account. If the answer to this is yes, then then you will account for a cash settled transaction. Okay. If the answer to this is no, you will account for a equity settled transaction. Okay. Now, if accounted as equity settled transaction, if you have accounted for it as an equity settled transaction, on settlement, if equity settled On settlement, if you have done equity settlement, then no further expenses are recognized, only movement between equity. Okay, so you'll only move between equity. If cash settled, then treated as buyback of equity interest. Okay, then the most important thing that you need to keep in mind is, if settlement option has a higher fair value, if the settlement option has a higher fair value than the other option, then difference is recognized in P&L as expense. Okay, so whether it is equity settled or cash settled, if you are settling it at a higher value, that is, let us say fair value of equity settlement is higher than the fair value of cash settlement, and you still go ahead and settle it at fair value of equity, then the difference between the fair value of equity and the fair value of cash will be debited to P&L and credited to cash or equity depending on the settlement mode that has been chosen. So settlement is, say, in equity, second case is cash, and higher fair value is of equity, and here also higher fair value is of cash, then difference debit expense, credit equity, and here debit expense, credit cash. Okay, so that is how you will do the accounting for share based payment transaction with cash settlement alternatives.